Jordan said, if you have any questions, feel free to post them in the chat. I'm going to let Jordan monitor that. She may stop me during the presentation to ask a question. She may hold some to the end. I do expect to have some time at the end to talk through things. So if you want to, super happy to do that. At the end, I'll also post my LinkedIn information. If you'd rather ask a question offline, you're more than welcome to connect with me through LinkedIn and we can talk that way. So super happy to answer any questions you might have. As Jordan said, my background is largely in engineering. I did that for a lot of years and really learned a lot through my graduate school experiences. I love my grad school, both at Utah State and Stanford, learned wonderful things that have been great footsteps in the past many years. I've loved my time as a software engineer, did a lot of work at a lot of different companies, and have really enjoyed working in the investment management industry for a long time as well. So kind of like to run through, let's see, make sure my slides advance here. All right. So I want to walk through some basic principles, and I think these basic principles apply whether you're in grad school, whether you're in retirement, or anywhere in between. And I really want to kind of walk through some things I hope will be helpful to getting you on a good path. I'm sure many of you are already doing lots of great things, and I'll talk about some things you probably know, some things you may not. Hopefully there'll be a good foundation moving forward. So the first thing I want to talk about is who's in charge. And by that, I mean, who's in charge of your finances? Who's in charge of paying your bills, managing your credit cards, doing your taxes? If you're single, then I hope the answer is you. I hope it's not your dad. I hope it's not your mother-in-law. I hope it's not your friend. I hope you're in charge. And if you're married or have a significant other, I hope that both of you are in charge. I find that many people have one spouse that is primarily in charge and the other one doesn't have a lot of information about what's actually going on. So I hope that you will, from the very beginning, both be in charge of your finances and both take responsibility for all of it. Along those same lines, there really is no better time to learn about income tax, to learn about how it works, to learn about what a standard deduction is, learn about what your tax bracket is. When you get a paycheck and you expect something to come out of it and you get less than you thought, what are those taxes in the paycheck and how do they work? I think all of these things are really important. Taxes are a huge thing, and understanding how they work over the course of a lifetime can really help you make better decisions. So I always encourage clients, especially my younger clients, to learn those things early and take advantage of that information to make more intelligent decisions going forward. So I'm going to teach you about a standard deduction. This is something many of you may know, some of you may not. So a standard deduction is the amount that you subtract off your income to determine how much money you actually pay taxes on. So if you're married and you file your tax return together, your standard deduction for 2021 is going to be $25,000. And that, again, is the amount you subtract off and don't pay tax on. If you're single, your deduction is half of that. So it's a very important thing to understand. I'll kind of walk you through why. So to calculate your federal income tax is really simple. It's not nearly as complex as people tell you. You add up all your income, typically salary for most people, add up all of that. And in some cases, you may have some things that get subtracted off. You may have an HSA contribution, an IRA contribution, some student loan interest. If you don't know what some of those things are, we'll talk about them later. For many people, especially younger people, you may not have any of those. And so once you subtract those off of your income, the resulting number is your adjusted gross income, your AGI. And so for a lot of people, income is the same as AGI. And then after that, you'll choose which deduction you want to take. Do you want to take the standard deduction or the itemized deduction? You'll subtract that off of your AGI, and that becomes your taxable income. That's the amount you're taxed on. The standard deduction we've talked about, that's the same number for everybody. It's $12,500 for an individual, $25,000 more or less for a couple. When you're younger, that's probably your best option. For some people, as you start to get more expenses and things like that, so as you buy a house, you'll have mortgage interest. As you donate to charity, which includes tithing, fast offerings, the food bank, the American Red Cross, all those things, all those charities, those count as deductions as you pay state tax to Utah, whatever. As you add all those types of things up, if those things add up to more than the standard deduction, then it's better for you to take the itemized deduction. If they're less than that, it's better to take the standard deduction. So in many cases, as you're younger, you may have the standard deduction being your best option. As you get a little older, buy a house, have a higher salary, pay more tithing, then it may be wiser to take the itemized deduction. But the bottom line is you take your income, subtract off a few things, subtract off your deduction, that becomes your taxable income. Then you go to a chart like this, and that tells you what your tax bracket is. So let's say your salary is $100,000, you're married, which means your standard deduction is $25,000. If that standard deduction is higher than your itemized deduction, then you're going to take that $25,000 standard deduction, which means your taxable income is $75,000, which means you fall into this 12% bracket. Zoom is great, but I really wish I were in person. I wish I could see your faces. I wish I could make sure this is all making sense.
Rob,
yeah,
we did have a question asking, and it might be a slide or two back, where it says, how does head of household work with the other two options?
Yeah, so head of household is an option that works for some people, particularly if you aren't married, but you have kids living with you. There are different situations in which that may make sense, and it's often a better option if you can file as head of household rather than as single. It's something you can read about and see if that situation fits you. It's certainly a relatively common one if you have dependents living with you, but you're not married, or for some other reason don't want to file as married. Follow-up question, is that good?
I think that's good, thank you.
Okay, awesome. So if someone asks you what your tax bracket is, it's really easy to figure out. Take your income, subtract off your deduction, and look at your taxable income, and then see what bracket you're in. So if someone asks you what's your tax bracket, what's your tax rate, it's going to be this number right here. And it's relatively easy to figure that out. If your taxes are a bit more complicated, there are of course more factors that come into it, but eventually you're going to come down to one number, and that number is the highest tax rate that you pay. All right, without getting more complex, it's really important to know that number, because you can make decisions about taxes better if you know what your tax rate is. All right, and we're going to talk about why it matters in a number of slides in the future. But it's important to know what your tax rate is. These will be considered low tax rates. These will be considered high tax rates. And then of course you got some in the middle, and we'll talk about specific reasons why that would matter. All right, moving on. So basic accounts that many people have or would want to get would include checking and savings accounts. Many of you probably have those accounts. Those are pretty useful to store cash. You may also consider or already have an investment account. That may include an IRA, a retirement account, which is something to save for retirement. I'll talk about that in more detail later. It may also include a taxable account, which again, I'll talk about later. But it's great to have these retirement and taxable accounts set up such that you can invest. One of the biggest hurdles to a lot of people in investing is simply the basics of getting an account set up. So I think getting that set up is a great step. There are lots of good custodians. We'll talk about those that hold these types of investment accounts. I've listed some of the common ones here. They all work great. There's some benefits of some over the others, but they all work relatively well. And these are common custodians, brokerages. Those are common names you may hear. All right, so some basic steps that you can take. Again, these are steps whether you're in grad school or whether you're further down the path. I think it's really important to understand some things about your finances. It's a little surprising to understand that over half of Americans live paycheck to paycheck. And that means that in order to pay for this month's expenses, those people need their check this month, which means they can't pay for next month's expenses until next month's paycheck comes. And that's a little scary. It's even more maybe surprising that about 40% of Americans making over $100,000 also live paycheck to paycheck. That happens to a lot of people as salaries increase. Something called lifestyle creep happens, where your standard of living raises in order to match the discretionary income that increased salary brings with it. $100,000 isn't what it was 20 years ago, certainly. There's a lot of things to pay for, but it's something to be aware of how your finances work. For a lot of people, it's easier to adjust spending as you look at the knobs and dials that you can turn to try to have money left over each month. For a lot of people, it's easier to adjust spending than it is to make more money. So your grad students, you are doing things right now that will help you increase income, which is a fabulous step. In addition to that, if you can understand your spending better, you can make good decisions about that. So one of the first things my wife and I did when we got married was to set up a Google Sheet and track our expenses. So we started tracking our expenses. We use about, I think, 10 or 12 categories of spending to track our expenses. Those would be groceries, it would be entertainment, it would be eating out, utilities, gas, house expenses. All those kinds of things are important to understand. I think many people are surprised after they track their expenses for a couple of months how much they actually spend in certain categories. So I always recommend to people who want to understand better where their money goes to track their expenses for a couple of months. Excuse me. A couple of months are usually enough to have a pretty decent understanding of where your money's going. So after you tracked it for a couple of months, sit down by yourself, sit down with your spouse, and figure out how much you spend each month in each category. You can then make decisions on how you want to allocate that money. You can make a plan, make a budget, whatever you want to call it, and decide, yes, we're comfortable with the way we spend our money, or hey, we're kind of surprised by how much we spend in this category. Let's maybe adjust that and do something a little differently. And then at the end of each month, come back and return, review, what you actually did that month and say, yeah, we're on track. We feel good about that. Or, hey, we're quite a bit over in this category. we weren't realistic. We need to raise the budget in that category because we know we're not going to do that. But I think spending time to understand where you spend your money is really important. My wife and I have done it our entire marriage. We track every penny we spend, and it's been very helpful to understand where our money goes. I don't think everybody has to do that. We probably don't have to do it either, but it's been helpful, at least for a couple of months, track that and learn where your money goes. I think by making those adjustments over time, over long periods of time, can make a really big difference. All right, Jordan, we good?
Yes, sir, we're good.
All right, we'll keep going then. All right, another basic step is to build an emergency fund. I think this is one of the very first things that any individual or couple should do as they look at their finances. When you have emergency expenses, which happen to everybody, when you have money to pay for that, you can typically make good decisions. When you don't have money to pay for that and you have to pay for it, many people end up making unwise decisions because they have to do it. And so, you know, sometimes you fall back on family and that works, but other times you end up putting something big on a credit card, you end up getting a payday loan, you end up doing things that are very expensive. And an emergency fund that can handle those things is a really helpful first step. You'll hear lots of experts recommend getting 3 to 6 months worth of income in an emergency fund. So that means if you make $2,000 a month, you'd want 3 to 6 times that amount stored somewhere in a very accessible format, cash or something like that, to spend. That's a lot for most people. So I recommend starting out smaller. If the most you can do right now is $100, do $100, and then increase that to $1,000, and then eventually get that to 3 to 6 months. That's a great goal to have.
Dr. Jacobs?
Yourself. Yes.
I have a question about that. So
Yeah.
would you recommending, where would you store that amount of money? Is that just like in a general savings account, or or would that be better to like invest somewhere else and just have that money as an emergency? Like where would you store an emergency fund?
So I will talk about that in the next slide, but the short answer is I would probably put most of that in something very short term. So cash, meaning checking your savings account, would be a great place. Depending on other factors, you may choose to put some of that in bonds, and we'll talk about what bonds are, how to do that. I personally have my emergency fund in bonds. And I think putting some in bonds is great, putting some in cash is great. You may choose to do some of each. But I think something like that would be a great place for an emergency fund. All right, so another basic step, again, we've talked about this briefly, is to set up investment accounts. Really easy to do. Just go to TD Ameritrade, Charles Schwab, Robinhood, whatever you want to do, and set up investment accounts. Some don't, most will handle all types of accounts. Robinhood, for example, doesn't do retirement, they only do taxable. But most of the big well-known brokerages or custodians will do all types of accounts. It'll take you just a few minutes to set up, really easy to do. And I think a really great step to have an account there. Whether you're ready to use it or not, I think it's great to have an account and know that all you got to do is send over $100 and you're investing. All right, this is my favorite slide. I love buckets. All right, so whenever my kids come to me, whenever a client comes to me and says, hey, I've got an extra $1,000, I've got an extra 10,000, I've got an extra 100,000, and I want to invest it, what do I do with it? The first thing we do is we talk about buckets. We talk about when do you need this money back? So is this money that you expect to use in the next many months? If so, it's going to go in that very first bucket. If this is money that you will probably use in the next several years, maybe a house down payment, that'll go in the second bucket. If this is something you don't expect to need for quite some time, could be retirement, could be a longer term planning for a vacation, lots of things like that, that will be in your long-term bucket. And the reason that matters is because we invest things differently depending on when we need that money back. So anything you need in the short-term bucket is likely going to be in cash. Some of that may slip into bonds, but it's going to be something that's very liquid, something that's easy to get to, something that won't change value dramatically, something that you know you can pull out at any time and the value is still going to be there. That middle term, that blue bucket, looks more like a sand pail to me, but that middle bucket is something I would typically recommend putting into bonds. You'll make quite a bit more money in bond than you will in cash in your checking or savings account. But the price is not volatile. The price typically doesn't go up or down very much. So you make decent interest, but it's relatively safe, not very volatile. Then that third bucket is something where I don't need it for a long time. I just want to get the most I can out of that bucket. And that would be a place you'd put into stocks. You get the best growth there. It'll be volatile, it'll go up and down, but over long periods of time, you can be pretty confident it's going to grow. So that's the most important decision. And as people come to me, we talk about how you want to put this chunk of money to use. You very many times may decide to put some in each bucket. You may say, hey, you know, I've got $10,000. I want to put, you know, 3,000 or 4,000 into short term and the rest into the middle bucket. And that's a really important decision because that helps you decide how to actually invest that money. Any questions on that?
I have a quick question.
Yeah.
So when you're saying that stocks is probably the like it's still volatile, because I've heard several different options. Like, would you also say that maybe long-term resources would be good in like a mixed portfolio, like a mutual fund, or like what's your take on other options besides stocks, maybe for long-term?
Yeah, that's a good question. So when I say stocks, I mean either individual stocks or stock mutual funds. There are lots of ways to invest in stocks. So an individual stock would be one example. And I don't frankly use individual stocks very often for lots of reasons. But a mutual fund that holds all stocks would also be stocks. So I would consider all of those stocks. Does that make sense?
Yes, thank you.
Perfect. Okay. And we'll talk about some of that a little bit later on. But there are lots of ways to hold bonds and stocks, not as just individual items, but as mutual funds and things like that. So I consider all of those that same type of thing. All right, so after you've got this extra money and you're figuring out what to do with it, the first thing I would do is I would build that emergency savings. That's the first place I'd put your money. That helps you make really good decisions down the road. And for many people, the second place to put that extra money is toward something really obvious, like, you know, high interest rate credit cards, things like that. That's a really great place to go next. And hopefully you get those first two knocked out of the way, and then the rest of your life, you're on this third step, which is to figure out where to put this money. So diversification is a term that we use that may not be obvious what it actually means. So diversification, the goal of that is to reduce your risk by putting money into multiple different places. So rather than putting everything in one basket, you put a little in this basket, a little in that basket, and thereby reduce the risk of putting everything in one basket. So if you've got a few hundred extra dollars at the end of the month, you may say, hey, we really are trying to save for retirement, but we also know we want to buy a house in a few years. Man, I really like to travel. And so you and your spouse or you and your friends may say, hey, this is what we want to do. and I would like to put some money in each of those baskets. And doing that's called diversification. If there's not one right answer, so the one right answer for some of you may be, I'm going to pay off my high interest credit card. But once you've done that, there may not be one obvious place to put it. And then diversifying across many different places is often a good idea. And it doesn't have to be done equally. You may say, hey, we really want to pound money into our retirement, but we also know that the house down payment is important. And so we're going to put half of our money into one and half into the other. Or you may put 80% into one and 20% in the other. It's really up to you, but diversifying that across different places is often a really good idea. So I always encourage clients and my kids to do that in every case. This is a great thing to discuss with a spouse if you're married, to make those decisions together and decide the right way for you to allocate your extra resources. Any questions there? All right. All right, who comes out ahead? So Sam plops down $250 a month into his retirement account at age 24. Sally saves double that, but starting later in life. Who's going to make more money? Rather than making the answer, I'll give you the answer. Sam's going to make a lot more money. And that may surprise you, it may not. But it highlights how important time is in investing. The amount you put away matters, but how long you put it away matters an awful lot more for many, many people. The vast majority of you are relatively young and you have time on your side. There's some really great things you can do with small amounts of money over a long period of time. As you get older, bigger chunks of money don't have nearly as big of an impact as smaller chunks of money when you're young. One way to highlight that is by teaching you something called the rule of 72. And this is a rule that I teach to all my clients, all my kids. It's a great way to figure out how long it takes for your money to double. So if I have a stock investment, a pretty decent estimate for a good stock mutual fund will be about a 10% return. That means that I take 72 divided by 10%, and that means it's going to take just over 7 years for my stock investment to double if it makes 10%. And so if you're age 23 and you put money in a stock investment that returns 10%, that money is going to double 6 times by age 65. If any of your math majors or any other kind of major, it's pretty easy to see how quickly that grows. That would turn Ben Franklin into $6,400. Just to be clear, if you take $100 and you stick it into a stock mutual fund and let it sit there until you're 65, if that makes 10%, that will turn into $6,400 just by sitting there. And I think what this highlights is the importance, one, of time in letting our money grow over time, but two, I think how much money something costs now versus just letting it not be spent and letting it invest, letting it grow over time. So that Chinese takeout may be much more expensive than you thought it was. And so it doesn't mean don't do anything fun. It does mean think about your money, think about what you're doing with it and deciding, is that really what I want to spend, or would I rather have that money growing for me and helping me retire with a better lifestyle? All right, investments. So stocks, many of you know what these are. The important thing is a stock, as we talked about, can be an individual company. It can be a mutual fund. It can be an ETF. So an ETF is a kind of a fund that in almost all cases is better than a mutual fund. You can go read about it. They're common. They're all over the place. But ETFs are almost exclusively what I invest in. And you can buy a stock ETF that holds lots of different stocks that I would consider to be a stock. So anytime we talk about stocks, a stock ETF, a stock mutual fund, those would all be considered stocks. So that's in that long-term bucket. The important thing to know about stocks is they're volatile. They jump up and down, and they have really good long-term growth. Bonds, the important thing about those is they can also be held in a mutual fund or an ETF. And they're less volatile, which means they don't go up and down in price very much. They're relatively stable, and they basically spit off income. So stocks are volatile and they grow over time. Bonds are not volatile and they basically spit out interest, if you want to call it that. This is a description of, it kind of gives a long-term historical view of what stocks and bonds return over time. So this is over the course of nearly 100 years. Over that time, bonds have returned a little over 5% annually. They can grow a lot and they can lose a little bit. Stocks, on the other hand, have grown quite a bit more, and they can grow really big and they can lose really big. Now, these numbers today are not quite right. In today's markets, this number for bonds is more like 2.5% to 3% annually, and stocks is somewhere between 8% and 10%. But the important thing is that over longer periods of time, you'll make significantly more in stocks than you will in bonds. All right, common investment accounts. So I'm going to walk through each one of these for a couple minutes and walk through what they are. So there's 5 of them. We'll kind of walk through each one individually. So first one is an individual retirement account, an IRA. I think most of you have heard that term. That's a place for an individual, a single person. If you're married, you may each have one, and you put your retirement savings into that account. You can hold stocks in there, bonds in there. Again, by stocks, I mean individual stocks, stock mutual funds, stock ETFs, bond mutual funds, bond ETFs. You can hold anything in that account. You can hold cash as well, but not as common. There are built-in tax benefits to those accounts. There are 2 main types. One type is a Roth, and the other type is a traditional. So a Roth IRA, the way that works is you'll get paid a salary from your boss, and they will take taxes out of that salary, and then you'll get what's left over. Then from the money that's left over, you will then put that into a Roth IRA. That's the way that works. A traditional IRA is the opposite as far as tax goes, meaning you'll get paid a salary. Before they take taxes out, you will put money into a traditional IRA. Then what's left over, you'll pay taxes on what's left over. What that means is you don't pay taxes on the money you put into your traditional IRA. So a Roth is better if you're in a low tax bracket. We've talked about tax brackets. If you're in that 10 to 12% tax bracket, which as graduate students, many of you probably are, a Roth IRA would be typically the best option. That means you're going to pay taxes on it at a really low rate. And then when you pull the money out in retirement, you're not going to pay taxes when you're at a much higher rate. Traditional is the opposite. Traditional, if you're making a lot of money, then you probably want to take a tax break on your IRA contribution. So you, in a high tax bracket, don't pay taxes on your contribution to your traditional IRA. And then when you pull the money out in retirement, you expect to be in a lower tax bracket and you'll pay taxes when you pull it out. So this is such an important point. I've got a few slides to talk about it. The top slide is if your current tax rate is high, you're making a lot of money, you're one of those higher tax brackets, you probably want to take a tax break and not pay when you're in the higher place. And then when your taxes go down in the future in retirement, you'll then pay taxes at that point. The Roth's the opposite. You'll pay taxes now when you're in a low tax bracket. And then when you make more money and pay more taxes in the future in retirement, that's when you don't want to pay taxes for a Roth IRA. So one last slide, super important, a Roth. So you put money in, your contributions, you'll pay taxes when it's a Roth. You won't pay taxes when it's a pre-tax or a traditional IRA. Both of them grow without any taxes while they're growing until you retire. And then when you retire, the Roth you won't pay taxes on. The pre-tax or traditional you will pay taxes on. So the only thing that matters is, do you expect to be in a higher tax bracket now, or do you expect to be in a higher tax bracket when you pull the money out during retirement? And that's how you decide. Questions on that? Awesome. I would think for the vast majority of you, a Roth IRA would be a fabulous idea. You're probably in most cases in a low tax bracket, and so that might be a really good option. So look at the tax bracket, and that's how you decide. All right, second kind of account is a taxable investment account. That's an account that you can put money in for anything. It doesn't just have to be for retirement. You can pull it at any time. You may put money away for retirement, may put it in there for a house down payment, maybe for a trip, maybe for college, for kids, could be for anything. You have cash, bonds, and stocks. There's no built-in tax benefits like there is to an IRA. There are some things you can do, but you have to know how to do them. They aren't just built in. This can be an account for a single person. It can be an account for a couple, anything like that. These are great accounts. And I'll teach you one of the very best ways to build in a tax benefit later on.
I have a question about that real quick. Sorry.
Yes.
Was that last one? This is also in the long-term bucket? Because it says non-retirement or retirement. Okay, so this could also be like a 1-year turnaround? Or?
You can, well, so in this account, you can actually mix. So you may mix all of your buckets in this one account. So I personally,
okay.
I have my emergency savings in my taxable investment account. I also have a lot of long-term investments that will be for retirement, will be for a future home. Those are also in the exact same account. So it's fine to mix all these in one account.
Okay, gotcha. Thanks.
You got it.
Rob, we have another question just asking, what is the max IRA contributions you can do in a year for tax benefits?
So it depends. It's about $6,500 per person per year. And then that goes up by $1,000 if you're over age 50. And there are lots of other factors that can come into play, but in general, that is the answer.
Thank you.
I actually have another question. So sorry.
Yeah, you're good.
Kind of going back to the Roth IRA, you're talking about how it's like hooked to your job that you have. But I mean, as grad students, like our jobs are like we're training right now, or we might not have full-time jobs, or we might have part-time jobs while we're in school. So would you recommend doing a Roth IRA once we're in our chosen profession or field, or would you recommend trying to do it now? Are they transferable?
Good question. So IRAs are actually not tied to your job at all. So IRAs are simply yours, and you can set it up wherever you want to. You can set up any one of those custodians. Has no relationship to your employer. It's simply yours.
So the money, do I just place the money in once I get my paycheck after the tax has been taken out, or is there okay, awesome.
Nope, you just put it in whenever you want to. So if you want to do a Roth, which is probably good for most grad students, you would simply open an account. Let's say you open an account at TD Ameritrade, you open a Roth IRA, and then you take some money from your paycheck. Once you get the money, you put some money in there and invest it in an IRA, in a Roth IRA. That would be the approach.
Okay, awesome.
All right. So the third kind of account is a company retirement plan. And this is the one that is tied to your employer. So you can't do one of these for the most part unless you're employed. So for many of you, when you get a job, many employers will have a 401k. There are other types of retirement plans for other kinds of businesses, but that's the way they work. A lot of them have matching, which means if you put in 3% of your salary into the retirement plan, the company will also put in 3%. The important thing here is many people contribute the same amount as the match, and most people need to put in a lot more than that. So if your company matches 3 or 4%, I think for most people want to shoot to get in 15 to 25% into that account. Again, there's lots of other factors that impact that, but for most people, putting in just the minimum to get the match is not enough to put you where you want to be. Those are tied to your employer. So when you leave your employer, you can either leave that there, you can transfer it to a different place. There are lots of other factors, but that one is tied to an employer, and you can only have it with an employer. All right, fourth kind of account, I'll talk about this really briefly, is a college savings plan. This is a great one if you want to save money for your kids' future education. Lots of great benefits to these. There are some tax benefits. They're very flexible. So great things about these accounts. You can read all about them. Utah has one of the very best plans in the whole country. It's a fabulous plan. All right, fifth kind of account is an account that it's called an HSA, a health savings account. You only qualify to have one of those if you have a high deductible health insurance plan. Many plans are high deductible nowadays. They're much more common than they used to be. As a student, if you have the BYU plan, it's not that. But as you get a job and move out, many people qualify for an HSA. An HSA is probably the best account you will ever have. It's the only account that has triple tax benefits. I'll show you a slide that describes that. I do a monthly newsletter. My last newsletter was about how to use your HSA better. If you want to look it up, just go to my website, whitepinefinancial.com, and click on the blog and read about this. There are some really fabulous ways to use an HSA. They're very underused, and they're probably the best account you will ever have. This slide kind of shows the tax benefits of all these different types of accounts. The HSA is the top one. It's the only one that gives you a tax break when you put money into it. There's no tax along the way as it grows, and you also get a tax deduction as you pull it out. It's tax-free. So it's the most fabulous account you'll ever have, and there are great ways to use it. The Roth IRA and the traditional IRA we've talked about. One of them has a tax benefit up front. The other has a tax benefit on the backside. The 529 actually has, in that very first box, there is a tax benefit. Utah gives you a tax break as you put money into that. So it's a little bit better than this kind of generic slide I'm showing. But in essence, it's a great account for educational expenses. And then a taxable investment account has no built-in taxable benefits, though I'll teach you one really cool one. All right, so if you want to donate money to charity, could be tithing, could be fast offering, could be Utah Food Bank, could be the Red Cross, could be a public university. If you want to give $10,000 in tithing, let's say, you will get a $10,000 tax deduction. You have to itemize your expenses or your deductions. You get a $10,000 tax deduction, and the charity will get a $10,000 chunk of money. That's how that works. Super simple. On the other hand, if you donate stock, it works a little differently. So let's say you put in $7,000. By the way, these are Cougar Blue. Both of these are Cougar Blue. I pulled it off the website. These are exactly Cougar Blue. So if you put $7,000 into a stock, and then over time it grows to $10,000, this bottom amount is called the basis. That's the amount you put in. This top amount is called the gain. And that's the amount, if you sell this stock, you'd pay taxes on that gain. And the tax you'd pay would be typically between 15 and 20% on that gain. But if rather than selling it and paying tax on that gain, if you donate that stock or that mutual fund or that ETF, you will get a $10,000 tax deduction. The charity, the church, the food bank, whatever, will also get the full $10,000. They will not pay taxes on it. You will not pay taxes on that capital gain. This is one of very few ways to actually eliminate a tax. You will not pay taxes on that, and this is a fabulous way to pay tithing, fabulous way to donate money to charity, fabulous way to eliminate tax. So great way to do it. IRS is all on board. They love it. They're happy to have you do it. The church is happy with it. Great way to not pay taxes legally.
So sorry, I feel like I'm asking so many questions, but
You're good.
so for this example, if you were to pay cash as a charitable donation, that's different than what's happening here. So in this instance, you're buying stock and then donating that stock to the charitable organization?
Correct. What happens is I'm gonna buy some stock. In this case, I bought $7,000 worth of stock, and then over the period of time, that $7,000 stock is going to grow to $10,000. Could be a year, could be 3 years, could be 5 years, I don't know, but over some period of time, it's going to grow from 7,000 to 10,000 in our example. I will then take that stock, again, could be a mutual fund, could be an ETF. I will then donate that fund to the church, and the church will get the full $10,000, and I will not pay taxes on the growth in that fund.
Okay, gotcha.
Great way to pay tithing, great way to donate to charity. If you pay cash, that works great too. But this is a really nice way to use your investments really intelligently and wipe away taxes at the same time. All right, investing 101. So this could take a day, 2 days, 3 more presentations, but I've got like 3 minutes. So we're going to do investing 101 in 3 minutes. All right. So things we know, I know the market's going to be volatile. So this chart right here, you can see this is a chart of a mutual fund. It's actually an ETF. It's an ETF that owns stocks all around the world. And you can see it's very volatile. It goes up, it goes down. There's big jumps up and down. But you'll also notice there's a long-term upward trend. Over time, it goes up. And good funds, good mutual funds, good ETFs over time go up. And that's a really important thing to understand. I can also manage taxes. Taxes occur when I buy and sell. That's how taxes work with investments. And so because I can control when I buy and when I sell, I can control my taxes. And that's an important thing to understand as you're investing. The last one is to reduce expenses. Every fund, every mutual fund, every ETF has a built-in expense. It's called an expense ratio. And every one of them has one. And you can own the same thing in multiple different ways. I can own the same, bundle of stocks in an ETF, or I can own them in a mutual fund. And typically the ETF is going to be much less expensive. And you'll find over time that a little difference in an expense ratio is going to make a huge difference over the course of 20 or 30 years. So this is a chart that shows a difference in, no expenses, 0.25% expenses and 0.62% expenses, and how many tens or hundreds of thousands of dollars that little difference has. So as you invest, pay a lot of attention to expenses. You can buy the same thing cheaper in many cases. The average mutual fund expense ratio is 1.5%. And you can buy things a lot cheaper than that.
I have a quick question on this.
Yeah.
What's your opinion on really low expense ratio index funds? Because I've seen a lot of those could be like 0.00, something % expense ratio.
I love them. It's almost exclusively what I buy. So I buy lots and lots of very low cost ETFs that have those types of expense ratios. You can buy a mutual fund that has the exact same stuff that'll be 10 times more expensive. So yeah, I think super smart to buy those very low cost ones. There are obviously lots of factors deciding how to invest, but one is buy cheaper. You can almost always do better. All right, one last slide is we often have something called a home country bias. That means that we typically feel more comfortable putting more of our money in the place we live. If you look at how the world invests its money, about half the money in the world is invested in the US. The other half is invested outside the US. They're really, really great funds that invest all around the world. And outside the US is ignored by many investors, or at least it's much undervalued. And for many, many years, the US does great. But in many other years, outside the US does better. And so I would just encourage you to look at the world. The world's a big place. There's some great investments all around the world, and the US is not the only place to invest your money. I am happy to take questions. So I can paste my LinkedIn information in the chat window. I'll do that in a second. If you have questions, I'm super happy to answer questions. My cell phone number's there, my email address is there. Super happy to help. We've got a few minutes, Jordan, for questions still, it looks like. So if people want to ask, I'm super happy to answer.
Yes, everyone, feel free if you'd like to unmute, or if you'd like to type it, I can totally say it as well. Either way. Rob, I don't know if you can see in the chat, we're getting a lot of thank yous. This was so great.
Oh, I'm super glad. I hope it was helpful. I hope you learned something. I know it's a lot of information in a very short amount of time. I know it's tough to grab that much information and digest it. There's no quiz afterwards. There's no reading quiz tomorrow. So do what you want with the information. I hope it's helpful. I hope you can get some good things out of it and benefit from that.
I do have one last question.
Yes.
Do you have any recommendations of, I know you said you mostly do ETFs and even low cost like index funds, but do you have like a specific recommendation, I guess? Like you talked about Ameritrade or E-Trade, or you had those possibilities. Do you have any recommendations for us?
As far as specific investments go, Miko?
Yeah. Or where to go, because I've been trying to find different companies and trying to compare, but I just want to know if you have any recommendations.
Yeah, to be honest, they all are very similar. The world changed about 2 years ago, and I won't bore you with why. But the bottom line is now the vast majority are very, very similar. You will not pay commissions in most brokers anymore, and so. I'm a fan. I like TD Ameritrade. I love Vanguard. I keep most of my clients' money at TD Ameritrade. I've got a lot of Fidelity. I own lots of Vanguard ETFs. They really all work in very similar ways. I know Robinhood's very common with younger investors. It does some good things. I mean, you can't do IRAs there. I'm honestly a fan of more standard places that you can do all the things you need to do rather than just taxable accounts. So but honestly, it doesn't matter to me. You can choose Ameritrade, you can choose Vanguard, you can choose Fidelity, Charles Schwab. They'll all be very similar and do it all very well.
And does that include kind of like that worldwide? Do they also do worldwide investments as well, those guys?
Yep, everywhere will. Everywhere will do worldwide investing. I'm always a fan of diversifying. So rather than putting all your money in one place, like putting it all into individual stocks or all of it into the S&P 500, which is the 500 biggest companies in the US, I'm a fan of putting it in lots of places. I think diversifying is a very smart way to invest. This is a question that I could talk about for hours. Obviously, it's tough to give more specific advice without doing damage. And so I'll simply say there are lots of great ways to invest. You can read, but in general, diversifying across lots of different types of assets is a great way to invest your money.
Awesome. Thank you so much.
By big companies, by little companies, by US, by not US, by lots of things is in general a pretty smart way to go.
Okay, awesome. Thank you again.
You got it.